Bitcoin isn't just another financial innovation. It's a living experiment in digital scarcity, a design that reshapes how humanity thinks about time, value, and trust. Every 4 years, this design marks its heartbeat with an event called the halving, a programmed reduction in the rate at which new Bitcoin enters circulation. This isn't random, it's deliberate. It's the rhythm of Bitcoin's existence, its built-in pulse. Every 210,000 blocks, roughly every 4 years, the reward that miners earn for validating transactions is cut in half. Less new Bitcoin is created. More scarcity enters the system. This simple but profound mechanism mirrors something deeply human: our tendency to value what is rare, what cannot be manufactured endlessly, what resists manipulation. For the first adopters back in 2009, Bitcoin was a curiosity, a digital coin mined on laptops, traded for fun, not fortune. Then came the first halving in 2012. The world barely noticed. Yet in that quiet moment, something historic occurred. For the first time, Bitcoin's supply rate fell below that of gold. Scarcity was no longer a metaphor. It was measurable. The halving is not just a technical adjustment, it's a philosophical event. It represents discipline in an age of excess, restraint in an era of printing. Where central banks can conjure trillions with a vote or a signature, Bitcoin can only release 21 million coins, ever. That contrast, between the abundance of paper and the precision of code, defines its entire story. Each halving begins the same way. The market is quiet. Critics call Bitcoin obsolete. The price stagnates. Then slowly, the rhythm asserts itself. Supply tightens, demand returns, and confidence spreads. From early adopters to global institutions, each halving leaves an imprint not only on the charts, but on culture itself. Across the decades, patterns emerge, not of speculation, but of evolution. The first cycle brought awareness. The second built infrastructure. The third invited institutions. Now the fourth is about integration. Bitcoin woven into the fabric of nations, companies, and individuals. These aren't random waves. They're encoded patterns, the consequence of mathematical scarcity meeting human behavior. In a world where central banks expand the money supply endlessly to fund debt, Bitcoin reduces its own supply predictably. One system is bound by politics, the other by protocol. And as time moves forward, that difference becomes impossible to ignore. When central banks print, purchasing power erodes. Wages lag. Savings dissolve quietly under the heat of inflation. But Bitcoin's issuance, its supply creation, moves at a pace no government can alter. Roughly every 10 minutes, a new block is mined, and every 4 years, the flow slows again. Predictable, transparent, incorruptible. Think of the halving not as an event, but as a meditation on time. Every 210,000 blocks, Bitcoin asks humanity a question. How much do we value something that cannot be diluted? It's a design that forces patience, not speculation. A rhythm that rewards conviction and punishes haste. In a financial world addicted to instant gratification, Bitcoin's halving demands long-term thinking. Decades, not days. Over time, these halvings form an economic metronome. Each beat recalibrates the relationship between energy, effort, and reward. Miners adapt, markets adjust, believers reflect. Through each cycle, Bitcoin grows not only more scarce, but more resilient. And that resilience matters. When prices crash, over-leveraged speculators vanish. When miners capitulate, the network reorganizes and strengthens. Volatility is not a bug. It's the process of discovery. Through scarcity, Bitcoin builds conviction. Through conviction, it earns adoption. And through adoption, it reinforces scarcity. An elegant feedback loop of faith and proof. Contrast this with fiat currency. Government-issued money like the dollar or euro. In fiat systems, new currency enters circulation through debt. Governments issue bonds. Banks lend multiples of deposits. Central banks adjust rates and stimulate economies with freshly printed money. The result? Expansion without limit. Each new dollar devalues the last, eroding savings, widening inequality, and distorting incentives. Bitcoin's architecture reverses this logic. It rewards early participation and punishes complacency. As time passes, fewer coins are created. Each Satoshi, 100 millionth of a Bitcoin, becomes harder to earn, harder to mine, harder to dismiss. Instead of inflation, Bitcoin introduces programmed disinflation, a gradual slowing of supply until one day issuance stops altogether. That day will come around the year 2140. By then, all 21 million coins will have been mined. The network will sustain itself through transaction fees, not new creation. A global engine of verification powered by decentralized cooperation. It will mark humanity's first monetary system with perfect scarcity. No rulers, no printers, no resets. And yet, Bitcoin's adoption doesn't happen overnight. It moves in cycles, like the halvings that guide them. Each phase introduces new participants, narratives, and understanding. At first came curiosity, then infrastructure, then institutional adoption. Now we witness integration. Public companies holding Bitcoin on balance sheets, countries recognizing it as legal tender, financial giants building custody and payment systems atop the same open protocol once dismissed as a toy. These transitions unfold slowly, almost geologically. Each halving compresses history, reminding us that time validates truth. Zoom out, and Bitcoin's chart resembles a living timeline. Exponential growth punctuated by valleys of doubt. Each cycle strengthens its foundation, spreading adoption across borders, generations, and ideologies. From hobbyists in forums to developers in boardrooms. From retail wallets to national treasuries. From digital curiosity to geopolitical instrument. Some call it volatile, others a bubble. But those who study its design see something deeper, a repeating structure of discovery, correction, and consolidation. Like the rings in a tree, each halving records a season of growth, struggle, and maturity. Bitcoin's endurance doesn't come from stability. It comes from survival. Through bans, crashes, forks, and criticism, it continues. Not because it's perfect, but because its foundation is incorruptible, decentralized, transparent, and predictable. No government decree can accelerate its issuance. No policy can delay its halving. It simply keeps going. Block by block, minute by minute, truth by truth. And in that quiet consistency lies its revolution. Because while politicians debate stimulus and economists argue about interest rates, Bitcoin remains unaffected, immune to opinion, governed only by math. Every halving reaffirms the same principle. Scarcity is strength, and time is proof. It challenges us to ask, will you think in decades or in days? Those who think long-term see that Bitcoin isn't here to make people rich. It's here to make money honest. Every 4 years, as the world doubts and speculates, Bitcoin quietly mines another block. Every 10 minutes, like clockwork, regardless of belief. That unwavering rhythm is what separates it from every currency before it. The halving is more than a countdown. It's a clock. A clock measuring humanity's shift from trust in institutions to trust in code. And as central banks race toward CBDCs, central bank digital currencies, digital versions of fiat money designed for efficiency but prone to control, the contrast becomes clearer. CBDCs will centralize surveillance. Bitcoin decentralizes sovereignty. CBDCs can freeze or expire funds. Bitcoin simply exists, borderless and neutral. One is programmable by authority, the other by consensus. Scarcity, adoption, resilience. Each halving renews this cycle. Each cycle brings more believers. And through it all, Bitcoin remains what it has always been. The purest expression of digital value in a world still learning what value truly means. So as the next halving approaches, look past the price and watch the principle. The code won't change. The clock will keep ticking. And the question will remain, will Bitcoin's cycles change money? Or are they changing us?